Welcome to the Property Funder podcast. I'm your host, Michael Dean. You can find me on the internet at property_funder. That's why the podcast is called this way. We're here today with Arjan. Before we speak to Arjan, I'd just like to give a word of thanks to the show's sponsor, which is Avamore Capital. You can find Avamore Capital at www.avamorecapital.com. Avamore Capital is a development and bridging lender based in London, but lending all over England and Wales, from projects from 250,000 to 25 million for bridge, refurb and development, amongst other things. Now, if you are a new visitor to the podcast, thank you very much. Whether you're watching on YouTube, listening on Spotify or Apple, or wherever else you get your podcasts, welcome. And what took you so long? If you are a returning visitor to the podcast, again, across the various platforms, if I can ask you, please, if you're not subscribed, to subscribe, to like us, and to give us a 5-star review, wherever on the channels you have that opportunity to do so. Now, Arjan, thank you for putting up with that, and welcome to the podcast. Would you like to just introduce yourself fully? Tell us the name of your business and what your business does.
Yeah, of course. Thank you for having me. So, Arjan Verbeek. I'm the founder and CEO of Perenna Bank, which is a different type of bank. It's a bank that does not finance loans with deposits, but actually issues specialist bonds to insurance companies, pension funds, asset managers to finance our assets. And our assets are long-term fixed-rate mortgages. Those are mortgages that exist in other countries. In Denmark, the US, those are the main users, I guess, although in the Netherlands, you have them as well. And this is a way of creating stability for people. It's creating stability in the housing market because you know what you're going to pay for the entire term. There is no shock. There is no cost of living crisis that can make shocks happen to your mortgage payment, and it's very safe. So that's why we're doing it, because as we know, there's currently a big shock happening, and many people are suffering because of loans that were taken out just before the crisis in 2007. So going back 10 years is not long enough to see where the problem started.
If you were to sum up what you think the biggest failures are of the UK housing market, what would you say that they are?
Well, the biggest failure in the housing market is the one that is not being even looked at, apart from what we are doing, and that is financing of housing. What we have is a very short-term mortgage market and a short-term way of funding mortgages, while the commitment that people enter into is for 30 years, and it's a long-term commitment and a very important commitment because everybody needs a house, a home, somewhere to live. Normally, what is the most stable way of financing is if you have your pension money finance the mortgage market, because it's a natural match to have a pensioner receiving £500 from a household that pays £500 under the mortgage. It creates stability. It's domestic investment in domestic assets. So it's really stabilizing for a country. And we don't have that. We import capital from abroad and we export capital investing abroad, which creates shocks. And that's why we have a very vulnerable financial system that we're trying to protect. But we're mopping up after the effect instead of avoiding the problem actually arising. And that is something that we underestimate. People say we need to build more, which will only happen if the properties can be sold. We need to improve the planning system. Definitely. I mean, nobody will deny that. But those are all improvements that do not change the core of our problem, which is the funding. Where does the funding come from? Where does the stability come from?
Where did you get the inspiration for Perenna? How did it come about?
So in the early 2000s, when I worked at Moody's, a rating agency, analyzing mortgages, the housing market, put a credit rating on loans and transactions, securitization, and cover bonds. Those are the two most well-known wholesale funding of mortgages, instruments to fund mortgages. I was at Moody's analyzing Denmark, Netherlands, UK, then went to Barclays Capital. Instead of analyzing, was putting the structures together. You can say that I contributed to the problems that we have now in the run-up to 2007. And that's partly true. Obviously, it wasn't just me, it was the entire market. You don't really know what was happening, but we didn't really have the warning signs. In the Netherlands, however, they saw things happening in 2002-03 already when lending criteria were tightened. We just didn't. So we kept going and we blew it up more than in other countries. Obviously, everybody had problems. And after the financial crisis, with the big banks that went bust were my big customers, you start analyzing what goes wrong in a situation like that. What did we do wrong? And then you think, well, in other countries, it has not gone that spectacular wrong, at least not for ordinary people in the street, because ordinary people in the street were really affected by something that was a banking crisis by specialists who should be knowing what they're doing. So that's why the idea started. Those countries have all long-dated fixed-rate mortgages funded by their local pension funds. They were hardly affected in the mortgage market. That's what we need here to restore the problem. Obviously, interest rates went down to almost zero. We had several bumps on the road after that. And people are forgetting that the last 10 years is where we look at is just not long enough. We need to resolve the problems that actually arose before 2007. That's where the idea come from. And that's when I started doing this in probably 2013, which is almost 11 years ago now. It took a long time to see what the right solution was, which is Perenna Bank.
One of the things just went through my mind, obviously co-owning and having founded a specialist lender of my own. I look at the model that you're putting in place. You mentioned you don't take deposits. Hold on a second. So you mentioned that you don't take deposits. Why then become a bank? You're selling effectively covered bonds, which are effectively a form of financial services instrument. Rather than going through the hassle of becoming a bank and suffering the overheads of becoming a bank, why choose to be a bank when, from my relatively uninitiated perspective, but with someone who, as usual, knows enough to be dangerous, why would you go through the hassle of becoming a bank when actually maybe wouldn't need to, given your current structure?
The reason is that as I mentioned, we started this in 2013 with a fund manager trying to do what they do in the Netherlands. Originate fixed rate mortgages through other lenders and then put the whole loans in a fund structure and have pension funds and insurance companies go into the fund directly, which would avoid having to be a bank, because we tried to avoid being a bank. What we then found is that the pension market and insurance market also have made wrong choices in the past. I don't know why people thought it was a good idea to have thousands of pension funds that outsource all their decision making. We're trying to now merge them back into bigger entities to get more domestic investment going and to get more control on that within the pension funds themselves. Insurance companies, we incorporated Solvency II in a way that it was very restrictive, more restrictive than in other countries, which means they couldn't go into whole loan mortgages either. So the only way that we could tap into pension savings, pension funds and insurance companies was through a covered bond route. Because a covered bond has three characteristics. It's issued by a bank, so we had to be a bank. It has certain types of mortgage collateral to make sure that it's really safe, because pension money, it needs to be invested, but it should not be risked. You can't lose people's pensions, obviously. And the third requirement is specific oversight. And obviously, the UK has an oversight regime for covered bonds. So having a covered bond bank was the only way to give the comfort and the ability of the investor base that we were tapping into to actually, make sure that they do buy our bonds.
So it was a function of necessity, essentially.
Absolutely. I wouldn't recommend anyone to go through a bank setup process unless they really want to. It's a long process.
Yeah, because presumably one of the only other attractions is the other attractions of becoming a bank are the ability to take deposits, which obviously you're choosing not to do, and then access to the wholesale funding market, which presumably you do or don't do depending on your circumstances.
Yeah, legally we do need to take deposits, so we can take deposits. We do not want to take deposits to fund our loans because long-dated loans funded by deposits is a very huge mismatch and a liquidity risk, asset liability mismatch risk. So, but to be a bank, we need some deposits. This is also why we're not seeing ourselves.
Sorry to interrupt. Can you just explain to our audience why you need to have deposits? Is it a regulatory capital component, or could you just explain a little bit more why?
It's a legal requirement. So a definition from a bank in UK law is that it's a deposit-taking institution. So to be a bank, you need to take a deposit.
And who do you take deposit? I mean, presumably someone can't. You don't have a branch where someone can where grandma can go and put £20 and £30 into.
Because of this structure, it's very important that our depositors are protected. And so we take deposits generally from wholesale depositors. That's what we're focused on. We could go and ask for permissions to take retail deposits. What is important is that all our deposits have their own collateral. So if anything happens to us, there is a pot of collateral to repay the depositors. Because our bonds cover bonds, as I mentioned with the three characteristics, they have the mortgages as collateral. This is why it's difficult for other banks to do it in volume, because if you give collateral to some party, you take it away from others. You structurally subordinate your depositors, which is what the regulators don't like. So by not taking many deposits, it's the minimum possible, we can issue as many cover bonds as that we like.
Yeah, because actually, I'm really glad you brought that up about what other banks do, and maybe you can just elaborate on that a little bit further, as kind of in the most accessible and simple way that I'm sure you're more than used to. Because one of my main questions was, look, there's no intellectual property really in finance. As soon as you come up with an idea, someone can steal it pretty much straight away. And we coined an expression called finish and exit. Even more, we became the best known in the market for part complete developments. But no sooner that we'd coined the phrase, that other people in our industry started stealing the sort of the moniker for, and even if it wasn't as good a product. So on that basis, there's really nothing to stop any bank or financial services institution trying to copy your model. So why Perenna? What's your advantage? I mean, you kind of were touching on it there, but could you just elaborate on that a bit further?
So if you are a traditional bank that funds mortgages with deposits, in essence, what you do is you print money, right? Because you decide to lend them to someone and you put the money in an account. So nothing has really changed. You just create money. Now, if something goes wrong with the bank, you need to sell the loans and then repay the depositors. And as we've seen in the financial crisis, that can be very risky because of the mismatch that there is between the duration of your deposits, which is overnight and short, and loans. That's why the regulator is very strict that the loans cannot be encumbered. Nobody can have access first because they're needed to repay the depositors. They're there for the depositors. So if you issue a covered bond, you take these loans and you secure them for covered bond investors. So take them away from the depositors, which is bad for the depositors and bad for the government who guarantees the deposits, obviously. So what we are doing is we take only a few deposits that we give some special collateral against. And then we can issue bonds to fund our loans without any concerns for the regulator because there are no depositors that they need to protect. And that's a big difference. The moment that you take deposits, it's very difficult to issue a lot of covered bonds. And that is very difficult to achieve what we are doing unless you go through the entire process of setting up a bank like us with all the documentation, variation of permissions, going through the or getting the banking permissions to set up a bank. So knowing how this bank works, what paper to fill, how the asset liability mismatch treasury function works, etc. It's a big moat. You can try to copy it, but not few people would like to copy a bank and set up a bank. We have traditional banks being set up in the recent past, but a bank like us hasn't been done before. I have no doubt that once we're operational, once we've issued the first bonds and we gain momentum, we will get copied and cloned. And frankly, I welcome that, because in Denmark, where our banking model comes from, you have 4 or 5 banks like us. And in the UK, which is a country 10 times the size of Denmark, not really sure, but it's probably
Possibly
something
more,
like probably more. We can have 10 times the number of specialist banks. Our mortgage market is 1.5 trillion. Naturally, it should actually be probably at least 0.5 trillion bigger, because we are missing 4 to 8 billion a month in first-time buyers coming into the housing market because they can't afford a house, but they want to buy. That's the difference in volume pre-crisis, pre-2007, and after 2007. That's the missing market. And then we have old people, old 50 plus, that have mortgage products from 2007 that cannot refinance them. And they need to have a refinancing product for it, like retirement interest only because you're 55. And the retrofitting, which is a 330 billion problem that requires a product to green up a housing stock and fulfill the net zero commitment. There's a lot of demand for mortgages that we don't have a product for yet.
They can't be satisfied effectively.
Correct.
Yeah. I mean, they're on my list of questions. Actually, I had you've covered a number of them, but can you maybe talk about how do your products enable, say, the first-time buyer market? You know, because that was the first thing you talked about, and obviously that feels to me like a very big unlock. How does it make, you know, how does it work that you would then be able to help more first-time buyers get on the housing ladder when they would otherwise be excluded from it?
Yeah. So we have our mortgage products in the UK are basically 2 to 5 year fixed rates. And then the mortgage after that period reverts to a standard variable rate, which is generally 8-9%, very, very high. And the intention is to just keep rolling. Now, obviously, the risk is after 2-5 years, interest rates are much higher. And then if you can't refinance, you go to the very high standard variable rate. Otherwise, you have a shock. Now, that's a risk to the system. That's the risk that we all found out in 2007. That's the vulnerable part. If rates hadn't gone down to almost zero, a lot of people would have defaulted on their loans. That's why there was no other choice. Now, what the regulator has done is put in place very strict affordability requirements. So you really have to stress test that a household can pay that reversion rate of 8-9%.
Right, of course, yeah.
And that's high because you pay only like 4 or 5%. Actually, the fixed rates in the market do not make any money for the banks. They are loss making. Where they make the money is by not paying depositors or the people on SVR.
Yeah.
That's where they make that money. But that makes the shock even larger, of course. Now, what we do is we give people a long-dated fixed, so the payment never changes. If the payment never changes, you don't have to stress. So we can calculate what someone can afford out of his or her salary every month and say that's what you can afford. And at this rate over that term, this is the amount that you can borrow. And that on average is currently about 20 to 25% more than that household could borrow from another bank on a traditional 2-5 year mortgage.
That makes a lot of sense, yeah. And if the penny sort of dropped for me actually midway through you explaining it, because of course, yeah, if you're only being allowed to borrow based on what you can afford on a stress tested basis, then for obvious reasons. I guess it's on, if I think from an investment perspective, it's sort of a bit like the ICR, isn't it? That you're testing more on 100 ICR, not 125 or 130. Yeah.
Correct. And we're having this really strange situation where someone paying £1,500 in rent, 7% yield, 6% yield, whatever, they cannot afford to buy the house, despite being able to afford 100% of the loan to buy the house, because the banks will not give it to them. And a loan that's large enough, the maximum loan that the bank will give them costs them only £1,000. And they say, I want to borrow and pay £1,500. But we can't give you more because of the regulations. So there's like a big gap between that, which does not make sense.
Okay, now let's turn that around. Your 3 years, I can even use my own personal experience. So back in 2006, bought a flat with my girlfriend, now my wife. My father, in his infinite wisdom, is a bit like a broken clock. He would, he's right, being right once or twice a day. He definitely got this one wrong. And he said, I'm really worried about inflation. I think you should lock into a 5-year fix. So in June 2006, locked into a 5-year mortgage paying 6%. 2.5 years later, mortgage rates are through the floor and we're stuck paying the best part of 6%. And then when we sold our property, we ended up paying a great big ERC when we moved into renting for a bit. A consumer in that position who's locked into a 30-year mortgage at, let's say, because I think at the time probably, the swap rates would have been probably about 5-6%, roughly speaking. They find themselves stuck or locked into a rate that's significantly higher than the prevailing rate. Can they migrate off onto can they effectively migrate their mortgage onto a lower rate mortgage? You package up their mortgages and a load of other mortgages and sold them as a financial product with a long maturity date. How do they roll off that? How can they roll off that, or are they stuck? Are they stuck then for the next 30 years having to pay that mortgage rate?
So, for people to take and select a long-dated fixed-rate mortgages, and we asked people in 2018, we did a survey before we started in earnest the bank process, and the regulator wanted us to show them there was appetite and what consumers thought. And consumers love the stability, would take and be willing to pay for that certainty and security. The key thing they need is flexibility. And that's what you're talking about. You do not want to have your life being dictated by your mortgage, right? You want to take advantage of interest rates going down. But you also want to be protected against interest rate going up, right? You want to have your cake and eat it.
Of course you do,
Yeah. And in America, they can. And in Denmark, they can. The risk is taken by the pension funds generally that invest. The interest rate risk is managed by the professionals that sit in between, and it's their job to trade that risk. And that's where it should be. It shouldn't be by the borrower on his primary residence. They have to live somewhere their entire life. You cannot lose that because the market goes up and down. So it should be safety first. So the Perenna mortgage is very flexible. Yes, you're tied in for 5 years, but you can afford that. So you might, if rates go down, you might say, oh, I could have had a better deal. But if they go up, you say, well, I actually have a better deal. But you have that safety and security. After 5 years, your payment is the same. If interest rates go down, you refinance without penalties, without lockup. And flexibility is, I would argue that these long-dated fixed-rate mortgages from us are more flexible than the 2 and the 5 year. Because if you are in a 2 or a 5 year, you just mentioned you paid high ERCs because you broke within 2 or 5 years.
Within 5 years.
Within 5 years. And they charge you a large fee. So you either are on a fixed 2 or 5 years, or you're an SVR, which is very, very high. So unless your life changes exactly on the refinancing date of your mortgage, you'll be locked in or paying a lot of money. So there is no flexibility. That's why you had to pay. And everybody at some point will pay an ERC
how can you get about how even taking that into consideration, if you've effectively spoken to a pension fund and said, I'm basically selling you a 30-year income stream, and it's, this is the rate that they're paying on it. How does the buyer of your covered bonds, how do they accept that after 5 years, potentially their income stream could go down? Or how do they reconcile that, or how do you sell that to them?
So it's basically reinvestment risk, right? They get money back and then they need to reinvest it. And that comes back to their pension liabilities they need to match. Now, reinvestment risk is taking a view on whether you at any point in time, if you have a 5-year investment, then after 5 years, you take reinvestment risk. If you have a 10-year investment, you take 10-year reinvestment risk. So reinvestment risk, every pension fund has, depending on what the liabilities are. So that complex modeling is happening. What additional complexity we add is, okay, they might repay earlier or later based on what market interest rates are doing or people's behavior. That can be modeled as well. So we are actually modeling people's behavior, people's ability to prepay, when they're going to prepay. And that's an option value that we price, that you put into the rate. So you pass the risk on to the market, but you pay them for it so people can take that risk and trade it.
Because presumably you can predict with a degree of certainty the number of people that will still retain their residences, retain their mortgages past the 5-year period. There's only going to be a certain proportion that will move, or maybe the average, maybe the average moving point or refinancing point might be 10 years down the line or whatever. Is that, and also people often are lazy and they're just not, even if there are cheaper options available, they're not going to move to a cheaper product.
That's called burnout. Yeah. At some point, you just can't be asked because your actual saving as a proportion of your income is just not worth the hassle. People don't like remortgaging. Nobody says, I'm going to have a remortgaging weekend, right? It's just not what people want to do. Most people will live their lives and not have to worry about their mortgage. Generally, the models that are applied in the US and Denmark are macroeconomic models. So if interest rates go down by so much and you're having so much of benefit, then people start refinancing. But with technology and AI, etc., you can do a lot more in the future, specifically looking at people's individual circumstance and say, well, they're going to refinance or not. For example, if you know that an individual that has your loan is getting married or has a child, that changes the situation, right? So you can predict that and you can work with that in combination with then the interest rate environment is. So you can proactively say, okay, you can refinance here, get a bigger loan for a new house if you think about it, and take your mortgage with you, which avoids the prepayment, and give an extra piece on top of that, for example. So you can manage that risk in addition to actually price it. And I think we can do much better now than what the old models in the US and Denmark did in pricing.
Is there a possibility or likelihood, though, that, we see obviously the FCA is having a go at banks not paying their as you rightly pointed out, banks not paying their depositors enough. Since the interest rate rises have kicked in, banks are sort of laughing all the way to the proverbial because they're holding all these deposits. They're able to charge much more on the mortgages that they sell, but they're not paying their depositors in that way. Is there a possibility that the reverse happens and you get told by the FCA that you have to make your borrowers' mortgages more affordable, those who are sort of locked in on longer term fixes? Is that a risk? Is that a real risk?
It's not a risk because they can refinance with anyone else
once they've gone past the 5 years.
Once they've gone to the past 5 years, but that's what the same with the 5-year mortgages. So there's no difference on that side, and the regulators are not telling banks to lower the rates because market rates have gone down automatically. That's not how it works. They're also not telling people banks to increase their deposit rates. They have a view that they should not interfere in pricing in the market, and I agree with that. They have to make sure, though, that pricing in the market is fair. And if you've taken at a certain point in time a certain product, you have to make sure that the pricing is fair at the point the product was taken out, and that's the important thing. And then obviously the flexibility to go somewhere else without huge barriers, and that's what we adhere to.
I want to get on to a little bit about the story about how you've got to where we are now, but I did actually want to talk about the Rio mortgages. The average age of our audience is probably sort of north of 35 or 40, but we'll have a good large minority that will be older listeners and viewers. There's I don't know if it's a misconception, but certainly there is a perception within the wider, certainly within the UK, that getting a mortgage as an older person is quite difficult, and there's only so many people that will do it. So I thought that your Rio mortgage proposition was quite interesting, and actually I like, and I can absolutely see why an older borrower who's perhaps got who's receiving a pension or a more they aren't at that stage of their lives where their income is going to continue to grow and grow massively like a younger person will. But do you want to just talk about the inspiration behind that and how the Rio mortgages work and who they're for?
Yeah. So it goes back to before the financial crisis when people were borrowing at interest only, on an interest-only basis, and they say we're going to repay when we retire. And for many people, that retirement point is now, and they have to repay the principal, and they can't. The only option they have is to sell their house, but they have to live somewhere. So trading down might not always be possible, and there's a big friction cost. So they have to have a loan to be able just to stay in their home. People should not take out interest-only mortgage. People should have their home paid off when they retire and have a pension to pay for expenses. That's common sense.
But we don't live in a perfect world.
But the world was perfect, if you like, from that point of view before 2007. From 2007, we started being very aggressive with our mortgage products and created the problems that we have now.
Isn't that ironic that the financial crisis has actually created a more risky product for consumers?
Well, if you let the private sector do what the private sector does, competitively push things to the edge, that's what happened. And particularly with deposit-taking banks, because banks print money, we inflated house prices away from incomes by just making riskier products out there. And now we have the problem. Now we need to resolve the problems. We need to now develop mortgage products to help these people actually live out their lives in their home that they want to live in. And that's what the Rio product can do. It can help these people because it's a new interest-only product, but the repayment is after they pass away, because then you don't need to live anywhere anymore. So that's the key thing. So the monthly payment stays the same, which generally can be covered from a pension.
So you take your underwriting is you look at evidence, you say, right, show me how much you're going to receive in your pension, right? I guess it's index linked, blah blah blah. Okay, this is your income, these are your outgoings for living expenses. Fine, yes, you can afford this. Yeah. You can afford this repayments. Fine, yeah, we'll lend you this, and like you said, up to 60% LTV. Yeah,
because generally they have an interest-only mortgage, they can't repay the principal, but their LTVs are low. So it's not real risky lending, but you have to make sure they can afford the payment. You've got also actuaries lifetime mortgages because they roll up, which is because they all generally have large ERC.
But presumably this is much more attractive than an equity release mortgage because you don't have to go and get the son and daughter or in the same room, because son and daughter don't need to worry about their inheritance with your Rio mortgage, right?
And those are all the discussions, because you have to give people all the options that are out there and put them next to each other. And a Rio is just a normal mortgage they had before. It's a standard mortgage. It's a standard mortgage, so they're used to it, right? So, but people generally don't want to borrow in retirement, and that's the right thing. They should not. But unfortunately, we're in a situation where people have no choice.
Yeah, I mean, there's if you want to play devil's advocate, you could also make the argument as well. It's like, well, they've got to retirement. They're probably rattling around in a house that's too big for them. Shouldn't those people be freeing up that house, downsizing to a property that they can afford, and freeing up that space for a family that desperately needs it? It isn't necessarily a view that I feel automatically, but I can certainly see why people would feel that way.
And I think you see that happen, and there are several problems actually doing that, even for the people that want to. People have a choice to do what they feel is best for them, right? And a lot of people want to stay in the house, in the area they know, etc. And that's fine. They have the ability to do that. If they want to downsize, they should do that as well. Unfortunately, that means apparently we don't have enough suitable houses to move into, which is obviously an issue. We have stamp duty, which people think is a tax on downsizing. Often
it is a big barrier to entry.
It's a big barrier, and then someone needs to buy our house. And unfortunately, if we have dislocated the entry point for first-time buyers, that is the start of the chain, so that people can actually downsize at the end of the chain. They're last-time buyers. And that's, the entire market is locked up because someone needs to buy your house to be able to downsize. And we don't have the first-time buyers to have this progression through the housing stages, unfortunately.
Yeah, and I think you've got products like Help to Buy, I say products, but things like Help to Buy, for example, which have really distorted that first-time buyer market, where it's almost like within certain locations, the entry point for a house buyer or flat hunter is the maximum Help to Buy threshold.
Yeah, the Help to Buy product I wasn't a favor of at all. I don't like it at all. It was put in place for desperate first-time buyers. And it financed 100 billion of properties. People want to own their home. The way the Help to Buy product worked is that the government gave you 20% of the value over the 75% 4.5 loan to income cap as an extra loan, as a second charge loan. Complex, inflation adjusted. It was a complex product. Most people would just say, I'll just take the whole standard loan because that's much easier and I'm in control. I own it all. On a long-dated fixed-rate mortgages, people could have probably borrowed the entire loan, the first charge plus the Help to Buy loan, as a standard mortgage. The reason why they couldn't is because the Bank of England has put this 4.5 loan-to-income cap in place. That is the biggest barrier to first-time buyers purchasing a property. And that's well understood in the market. It is even acknowledged now because the Building Society Association has commissioned a report on this, where they say you will have to remove the LTI cap to help first-time buyers onto the ladder. The Bank of England has not shown any willingness to do that, which is wrong. I understand that they want to protect against excess leverage because they were too late to introduce it. They should have introduced it in 2002.
Well, they were too late to spot the signs of inflation lately, and they'll be too late to cut as well.
Everybody has an opinion, but they should have done it earlier. They didn't, but now it's in place. It is hurting the recovery, right? So my view is that long-dated fixed-rate mortgages that protect borrowers against shocks, they should be able to borrow what they can afford out of their salary every month. So should not be part of the 4.5 LTI cap.
But okay, so you've raised this LTI cap. As things stand, are you still subject to you're still subject to that? So does that not then restrict the amount you can lend to, say, the first-time buyers? So the product that you want to make available, you can't. Is that or have you still got a way that you can make it work?
So it only starts once you originate more than 100 million a year.
Right. Okay.
So we're exempt from it as we speak.
But 100 million is a drop in the ocean in the mortgage market.
Absolutely. The other thing is, at the moment, we would be capped at 4.5. Other banks are basically capped at 3.5.
Why?
Because they have to stress at 9% and we stress at 6%. So at the moment, it is not that much of a restriction. If interest rates were to go down, then it really starts biting. So at the moment, it's fine.
So I say higher, but more, should we say more long-term normal interest rate environment. But if we go back to a lower interest rate environment, it becomes a bit more problematic for you.
Yeah. So it's fine now, and we have a lot of other business lines, and there are exemptions to this as well. People that refinance, for example, you don't need to. You don't need. They are exempt from the cap, but the cap is a big barrier to economic recovery as well, because there's no homes being built because they need to be sold. If you can't sell, you can't. They will not be built. So just opening it up gets house building going, which is 15% of GDP directly and indirectly. Also, we have a potential lost generation of homeowners that don't own a property in retirement that then need to rent, which is not the best way either. So I think people underestimate the benefits of home ownership or the impact on the economy because of lack of home ownership. People say it, but it hasn't really sunk in. And other countries, the better countries don't have an LTI cap. They control affordability. Some other Commonwealth countries are beginning to put LTI caps in place. Canada has done it on a bespoke basis per bank so that they can adjust to what's right. New Zealand just introduced one at 6 instead of 4.5 because they recognize they can't stop the market. The Bank of England thinks this doesn't hinder the market, but every mortgage lender knows better. And the Building Society Association paper shows that it's a big barrier.
Do you think the recent rises in people's incomes, so I say relatively speaking, I know they've been suffering for a long time of low pay growth. Obviously, we've seen quite a lot of pay growth in the last, 24 months with a relatively flat housing market, even going slightly negative at certain moments. Obviously, we've got some market commentators predicting a 35% crash, which I think is not looking likely to come to pass, but who knows? I think on that basis, do you think that would drive further justification for the argument that 4.5 times LTI cap is now too restrictive and with people's incomes relative to house prices now in a better place, that would justify a 0.5 point or full 1x or half x increase in that LTI ratio?
House prices are not going to go anywhere, in my view, and wage inflation, will get to restore the equilibrium at some point. With the LTI cap in place at 4.5, it'll restore much later than if you had the LTI cap at a higher point, right? So the economy will rebalance. House prices are, on an inflation-adjusted basis, going down and have gone down quite a lot.
In real terms.
They have.
I'm speaking obviously nominal terms. Most people don't. No one sells their house to go, well, in real terms, I lost money on it.
100%. We live in a nominal world, right? So my view, house prices are not going to go anywhere for a while because people just can't push house prices up because they don't have the ability.
I'd argue against that just on a simple basis that household formation is continuing to increase, and you yourself have highlighted the lack of supply that's coming through, and you also, thank you very much for also highlighting and you'll excuse my French, the shit show that the planning system is in. So I can see the logic in a market that's delivering a logical amount of supply. That I see a strong case for why that house price equilibrium will do what it's going to do. I'm not sure I completely see. I don't see, because of the other factors that feed into it, I don't see that it's going to remain flat or go nowhere. So
the reason why I believe that is because house prices now are, I think, 6.1 LTI average for the UK according to Nationwide.
That's against their actual price, not the mortgage, but the actual price is 6.1 times their income.
The average income in the UK, and the house price is 6.1. If you cap it at 4.5, what people can borrow as a household.
Well, you need to have 25% of the house price as a deposit.
You need a lot of money as a deposit. So,
which is fine if you've already got a property and you've built up equity in it. But it's not easy if you're at the beginning of your housing, the beginning of your journey on the housing ladder. You don't have that.
So my point is that if you have 10 people, 20 people, or 100 people, right, that can borrow up to 4.5, none of the 100 people have got enough money to get to the 6 because they don't have that deposit.
No, most likely.
So they can't push house prices up.
And with rents being so high, they can't save any money.
They can't save either. And that's my point. So it is not that there isn't more demand than supply. I totally agree with that. The problem that we have is demand cannot complete on the purchase because it doesn't have the right funding for it. So while there is a lot of demand just can't borrow enough to transact. And that's the problem.
Yeah. The Bank of England might argue though that maybe they almost want that though. That would they not want? They want to keep the housing. If we can't, we're never going to be in a situation in either of our lifetimes that we're building enough housing, right? So on that basis, I would imagine if I'm sat at the Bank of England, and think, well, okay, well I'm never going to fix the supply problem's never going to get fixed. So the only thing that we can, I've got this tool here which actually is effectively restricting the number of people who can get in the housing ladder. So as a consequence of that is going to tamper down pricing. And the only other source of, I suppose, external source of capital that can come in and hoover up the built properties at a higher price would be international capital, which again you can put regulations in place to prevent that.
Yeah. So you're probably right, but I would disagree that that's the best thing for the country.
Oh, no. I wasn't saying that was the best thing for the country. But if I'm in the Bank of England, I know that I can keep the tab on that.
Because they have other things they should look at, right? Growth is an objective for them as well, right? Economic growth. Keeping the housing market where it is not helping the economy recover. Also, they refer to Denmark, for example, and say high leverage is dangerous. And over 4.5 loan to income, people really start cutting back consumption in time of stress, which is true. However, what they forget to actually point out in that table that they published is that, yes, over 4.5 LTI, people cut back. But in Denmark, if they borrow at that, they cut back half as much as the UK. And the people that actually have a loan at very low LTI, they increase spending. So for an economy, if you don't want this spiral effect downwards, you want to have long-dated fixed-rate mortgages because it offsets the decline in consumption in the market. People also say, but the economic transmission model of interest rates is being hampered. And it's like, well, to be honest, if you have a complete variable rate market, interest rate changes filter in immediately. If you have a fixed market for 30 years, like in the US, interest rate changes also filter through immediately because you know it's not going to affect the borrowers. So you know instantaneously what's going to happen. If you have a 2 and a 5 year fixed rate mortgage, you have to wait 2 to 5 years to see really what's going to happen.
Well, on that note, actually, when I think about it's not the first time I thought about it, so we haven't seen. We every month we look for inflation data, and we haven't really seen the impact of inflation and the interest rate rises on consumption immediately. You have to wait until people move from their cheap mortgages to their expensive mortgages to see how that impacts how their lifestyles change as a consequence of that. And of course, now we're looking at the most obvious side of that is retail sales. Retail sales are through the floor at the moment. And yet the Bank of England won't move on interest rates because, you've still got the effects of increases in the national living wage into the service sector inflation. But then, of course, now I'm hearing anecdotal stories about people middle management level, like 40s and, late 30s, 40s and 50s now starting to be made redundant in white collar jobs. So, of course, these things just take time to filter through. And I think you're, so I think the point you make is absolutely spot on. And actually, but I wanted to pick up on another thing that you were talking about there, which is a bit of a bête noire of ours. And to our viewers and listeners, apologies if you're hearing this not for the first time. But you make a great point that as what we spend as a proportion of our take home income across the country, is a ridiculous amount proportionally on rent and or mortgages. And certainly if, by reducing the burdens on households of rents and mortgages, we will have a far more robust, far better economy, probably far better society, frankly, because more money will be able to be spent and or invested in things that people want and need. I don't know if that's a sentiment that's at the heart of your sentiment, or whether you think that there's other areas why by reducing the housing costs more generally is a priority.
I agree with that, and it's got to do with your ability to spend, right? As I mentioned in Denmark before, when you're a first-time buyer and you stretch yourself. I remember buying my first flat. I had £10 left every month, but I had my home, right? And then a year later, you get a pay rise. You get more comfortable, right? And then, but as long as the payment doesn't change.
Yeah, exactly.
Right? As long as there are no shocks, every year you get more comfortable and you have a better and healthier life. And you can make choices along the way. And that's why when you have 1 times income as leverage on your house, you start having a bigger income and you can really start spending, right?
Yeah.
You need to life cycle this all through. And by putting the 4.5 cap in place, you stop that life cycling. You basically put a line in the sand and stop it. And the generation that wants to buy and get into this lifestyle is not able to. And that hurts the economy. It hurts growth. People love spending on their houses, right? If you own a home, you go and paint, you get tradesmen in, you do things, you buy stuff for it. That's not happening when you rent. And we're lacking that driver of growth in the economy.
Let's slightly change tack now, Arjan, and let's talk about the delightful process that is becoming a bank. So you mentioned that you sort of the beginning steps of Perenna were around 2013. How long did it take you to go from founding the company to getting that banking license? And without boring people too much, what were some of the more frustrating things that you had to do to convince the PRA and the FCA to give you a banking license?
So from 2013 to February 2017, we tried to do it via fund manager, and that didn't work because what we talked about before. In July 2017, we had our first presentation to the startup bank unit of the Bank of England, which was a great initiative. It gave you a process that told you how to become a bank. So we made the first presentation, and they asked the same question as you did. Why do you want to be a bank if you don't want to take deposits to fund mortgages, which was an alien concept, right? So that was one of the big hurdles. And then we've got encumbrance rules. Why should they not apply to you? Right? That explanation. So we had a bit of a longer process to explain this new type of bank that nobody knew about in the regulator. It's a concept in Denmark and Germany, other countries, but not in the UK. So that meant that it was a slightly longer trajectory, and getting all of that shoehorned in the existing rules and regulations. Because let's not forget that the rules and regulations are generally always behind the curve what happens, and they're there for the current market. They're not there for what will be by definition. So that is always quite difficult to shoehorn it in, but we managed to make that work. And obviously we had a pandemic in between, which kind of stopped things. I must say the Bank of England team that we worked with was good. It changed a few times, and they had challenges to understand. They asked questions that we think, well, this is kind of obvious. You forget that we come from, well, I forgot, we come from that world. So for us, it's quite normal. And questions are, that's obvious. Why do we need to go through this effort to give you the evidence for it? But there are rules and regulations and things to follow. So we went through that. We've never had a negative sentiment from the regulator of what we're trying to do and what we are seeking to achieve. I think the problem in the market, etc., is well recognized, and the solution is I think understood as well. Although regulator is very big, so it has all different departments and different mandates within that, of course. And let's not forget that in 2004, the government already wanted to introduce long-dated fixed-rate mortgages. If David Miles' report was acted upon and pushed through, if you like, by government policy at the time, the world would be, or the UK market, I should say, would be a much better place today than we actually are having. So it's a shame it didn't happen in 2004. But that's where we are. So it wasn't completely new to people that long-dated fixed-rate mortgages could do something. So it was a long process. We learned a lot.
So when did you make the first application? When did you first file the papers for our first application?
So it's a process that 2017 started with. It started with initial, then you get invited to go further. We were asked a few other questions specifically to our banking model, and we submitted probably our official application in 2020, I think. And
the license came when?
And we got our license in August 2022. And we got our restrictions lifted September of 2023 from memory.
Wow.
And that's when we started lending. So it's been a long journey, but we're now out and we are getting increasing traction. And that's very good to see. Finally, we're actually doing what we're supposed to do. And we are very happy if people go and try and apply for mortgages to any other bank, right? The whole point of us is go and try to get a mortgage that you want from anyone else. And everybody else competes with each other. And then if you can't get what you want from them, then come to us. Because then at least we know that, we're not wasting time on trying to fight for you. We don't want to fight for you. We want to help the people that are not being serviced by all the other banks.
You've got, and look, at the end of the day, there's such a plethora of options across all specters and spectrums of financial services, and AP Capital as one example. We operate within a very specialist end of the finance market. We have to find our niche, and by the same token, in a much bigger but in a much more competitive environment, you have to find your niche too. So that makes perfect sense. Presumably, though, I mean, how many people did you start Perenna with, and up to the point where you got the banking license, how many people were you at that point?
Yeah. So when we decided to set up a bank, you start looking at what skill sets you need in addition to ours. So we found a few people that added to that. First application were probably 5, and now we're 80, 90. Building the bank took a lot of different skill sets, and we got a lot of different people on board. And we now need to just going into the right sizing, not building, and see what the best structure is for the bank going forward to grow. But it's all a collection of skill sets, right? Nobody has all the skill sets to do everything. And you need to find the people that create that stability.
My follow-up question to that is that you spent a long time not making any money, effectively. Or if you had any revenue, it was being swallowed up by overheads very, very quickly. Yeah. And I imagine even now you're writing business, you're still not making money because those, the overheads of being a bank, for those that don't know, are quite significant. How did you finance the journey? Presumably you've had some investors that have helped you along the way.
Well, it started by eating up our own savings. I still remember saying, I quit my job to go and do this. It almost cost me a divorce. Oh, well, it's a big shock to the family. And I'm still grateful for them to suffer with me through the journey. Yeah. And that's what they keep reminding me of. We suffered through the journey with you. And that's right, because it has a big impact. I would never trade it in, though. It was an awesome experience. So we started with our savings, then got some friends, family to help us along, started issuing shares to them. Then we have
a very traditional startup story.
Very traditional startup story until you get to actual banking license, because you can do it with relatively small tickets. But then as a bank, you cannot do anything until you're allowed to do something by the regulator. To do that, you need 2 big checks, basically. And we were lucky enough to find a US private individual who provided those checks for us. And
so just a single high net worth or family office,
very high net worth individual that helped us through the Series A and the Series B, so that we could actually prove that people want our mortgages.
Exclusively them, or did you have other people that come into the Series A and Series B?
They were the big ones, and then we had some existing others that helped us along earlier as well. But there weren't any real new ones in Series A and B, just existing shareholders.
So was that when the story slightly diverges, because you would have, if you were to look at some of the other neobanks, your Starlings and whatnots, your Atoms, presumably they would have had all the sort of usual suspects from the PE and VC community, and your investment based or investor base was much closer to, was more unique, should we say, in that respect?
Yeah, we were a bit unfortunate in the sense that the investor world changed basically when we were going to look for the big checks.
This was about when?
2019, 2020.
Yeah.
I mean, we had COVID obviously coming.
COVID, what a bad time to do that, right?
Well, exactly. And in the past, people were just looking for growth and opportunity and put money into startups quite readily. But when we got there, and it wasn't about profitability. People just didn't think about profitability. People just thought about growth and plans. When we got there, it was all about profitability and how long is it going to take. So we had quite a difficult journey on that. But we're going out for a fundraise now where we're actually lending, and obviously that's still always an exciting time, but also quite challenging times. But we should be able to raise it. We have a good business model. We have a huge addressable market. We have a business model that we can roll out to many other countries. So it's a real growth story. It's now about converting that.
Yeah, I can see that. I can see why it would be a challenging time. Do you think things like the collapse of Silicon Valley Bank, as one example, makes the investor community? I mean, let's also remember that it's not an easy time. Certainly, the last 2 years, in particular, broken IPO market. It's a difficult time to raise money as a sort of fintech. You throw in bank failures like Credit Suisse and Silicon Valley Bank. Do you think that has made, I'm asking a very obvious question, but do you think that's made the fundraising environment more difficult as well?
Absolutely. I mean, there's a few things. First of all, raising money for banks has always been more challenging because it's highly regulated. It's more difficult to understand. It's more technical. It needs more capital than an app or something that goes to the market. You can very easily show an MVP, etc. The other thing that we've had, obviously, is that the fails of Silicon Valley Bank, it has spooked people in quickly. Oh, we don't touch any banks, without going any further. People need to realize that we do not carry Silicon Valley Bank risk. Because
you're not taking depositors
exactly.
There's no cash from a depositor.
Correct. And people then
but you get tarred with the same brush anyway, don't you?
Correct. And that's people should actually see that we're different, which is the opportunity. And people say, oh, we don't like investing in asset heavy businesses. Well, I can understand asset heavy to some extent. But a bank is 20 times levered. That's not,
You're very balance sheet light in that respect, right?
Exactly. Banks are kind of asset heavy, but equity light compared to that. So, and you see the other banks that are now trying to become profitable or are profitable. They are profitable because they're lending. They weren't profitable before, but they're profitable because they started lending. Lending is very, very profitable. And you sit on deposits. You have to do something with them to make money.
Yeah, no, well, quite. And in terms of exit, when you're talking to these, when you're talking to people when you're fundraising, you're obviously trying to give them the hard sell as to they're going to get that money back and many times over. What does the exit look like? When you're painting that picture to them, what does the exit look like?
So, from a multiple point of view, or from a who's going to buy it?
I guess who's going to buy it, really? Yeah.
Yeah. So it depends a little bit how the market is going to develop, because, like I said before, we might be cloned 10 times because the market is so big, and when the business model is up and running, it's a good thing because it creates a liquid bond market, etc. Or one of the banks that might buy us, or one of the asset managers might buy us. We can go and IPO. In Denmark, the biggest one, Nykredit, has been bought by 4 pension funds because they buy the bonds anyway. They might as well have the equity.
So they're effectively securing the flow, right?
Correct. Yeah. So it's going to be interesting to see who is going to do that and how. Personally, I want to be able to put my equity in my pension. I want to buy the bonds myself in a pension. We want to introduce retail bonds. So I think a listing is the most appropriate. Spread because it's a very low risk bank once it's up and running and makes money. It's
an asset light model. You're not going to need on that basis. You're not going to need to be raising capital on a regular basis to shore up some loss on the balance sheet, right? Correct. Because effectively that balance sheet risk has been taken by the pension fund that owns the covered bonds.
So, the bonds and the equity is just churning out cash flows, and it's a matter of getting to size to cover the operating cost, which should be very low with technology actually helping us. Yeah. Just to pick up on the technology, a mortgage, everybody pays by direct debit. How many people really get into trouble on arrears? You should be able to self-service your mortgage on your app if you make a change on, name or whatever thing you do. Most people don't think about their mortgage until they need to, right? So there's not much attention necessary. You can manage a lot of volume with only a few people. Most of it is technology based.
Presumably the biggest. Aside from the regulatory side of things, regulatory headcount, presumably the majority of it would be relationship management and underwriting. Yeah. So
the beginning. Yeah. So once you have
how automated how automated is that underwriting process? And can you improve it from where it is now?
It can always be improved, but we are trying to automate everything as much as we can through the credit scoring, through affordability underwriting. Every bank still takes ONS data to really see how much should be spent on what from an income in the future. That should be open banking and more tailored. So a lot of the work and expenses in origination, underwriting, front end. But then if you have a 30-year fixed rate mortgage, you don't have to do anything for 30 years.
Once you've got the client, yeah.
Exactly. And unless there's a change or you need to have a touch point that someone moves or anything like that. But otherwise, there's no work to be done.
No. What's the level of given your business plan that you'll be going on your roadshow talking to your investors about? What's the lending volume need to be at to break even?
So probably at a balance sheet of around 2 billion, let's say, roughly 1.5 to 2 will be break even.
With an average mortgage size of 200,000, yeah. So that's not that many mortgages.
If you think about the size of the UK mortgage market, and every month basically 20 billion is being written, 2 billion is not that much.
No, Britain, new business being written, or Or churned, yeah.
Churned, because we have the 2 to 5 years. So it's not all home buyers. It's about 50-50, I think, and remortgaging has reduced a lot because everybody now is product switching with existing lenders more than actually remortgaging. But and the house buying market is depressed a bit. So there's a lot more scope for growth if the market actually works properly.
Yeah. And if you can unlock opportunities for first-time buyers as well.
Which is the missing piece of the market, right? That is where we really are focused on, and later life, of course. But
yeah, how are you going about distributing the products?
So we'll have 4 routes to market, although they are connected. Now, at the moment, we're going via brokers, which is a standard. 95% of mortgages are written by
brokers. And it creates a degree of efficiency for you as well.
Correct, because it's variable costing to a large extent, apart from the BDMs, of course. We are investing in and designing a direct-to-consumer route for people. It's hardly being used, but I think for us, people need to be able to just do it if they want to. Non-advised, do it yourself. It's not very difficult. You borrow this much, you pay this for 30 years, and after 5 years, no penalties. That should be very quick and easy. Thirdly, what we do is we want to work with other lenders. Like I said before, everybody should just try another lender. And if the other lender doesn't have a product, then try us. But why can't the other lender just write our product? And we will fund it.
So white label it.
White label it, forward flow to us. And that's something that I think will be successful. It's just everybody wants to be second and third and see that the product works before spending time on it and onboard it. So, but that will happen, and conversations are taking place. And the fourth one is embedded finance. You know, why don't house builders originate mortgages that we do? Property websites, supermarkets. They've tried before by setting up their own banks. They don't need to have the infrastructure. They can just use their brand, and we do everything behind it. So that's another thing that I think will take off. But we'll see. We're very flexible. We want to have all the touch points in the world to get volume, because that's how the core strength of us is the funding model, the banking model, and the technology we put in it. It is not doing mortgage lending, because that's been around for a long time. Well,
I'm fascinated to see how it's going to play out for you, Arjan. Switching gears a little bit, as we sort of start the wind down, and really appreciative of your time today. Just to ask a few things about your personality and your lifestyle. I say personality, your basically your life outside of work. Because you've been, as you said, you've been on a very exciting journey. It's been probably very stressful, as you alluded to, the near divorce, and I can relate to that to some degree. I'm sure my wife, if she's listening to this or watching it, she may nod her head at times. What do you like to do outside of work? That, I guess, to kind of keep you, to keep you a bit more on the straight and narrow, a bit more settled, to help you take your mind off things when things get a little bit too exciting. Yeah. So the big thing I do is watch football. That's really the one thing that keeps my mind away from it, apart from family, obviously. That's the other part of it. But football is the one where I switch off. And people ask then, who do you support, etc. And I still remember coming to the UK in 93, 94, and I lived in Earl's Court, and I saw all these people walk past to Chelsea, and that's when I just joined the queue. And those days you didn't need a season ticket. You could just buy a ticket there and you sit there. That was a great experience. First time sitting with English football supporters as a little Dutchman who didn't really understand what they were saying. That was scary, but I've kept going back. And of course, a couple of years later, after you've gone there, maybe when they got rid of the cars from behind one of the end of the goal and put the other stand on. Yeah. Ruud Gullit came to Chelsea, didn't he? And we had several Dutchmen. And Gullit, Hasselbank, Bogarde. There was your namesake, Mr. Robben. Arjan Robben, of course. Yes. So it was exciting. We had ups and we have a big down at the moment. Hopefully we can go back up again. What do you think? What do you think of the removal of Pochettino?
I'm very sad about it. I think he didn't inherit something that was really good, right? And he managed to get us into Europe Conference League, but still, it's there, sixth. Never thought that would be the case at the beginning. So I'm quite sad about it. We'll see what the Leicester coach is going to do. Or pick it up. We've tried Potter before, which didn't work. Is this a similar story going to be? I don't know. I just like stability and love to go there. And the only thing I want to see on the pitch is them running around and trying hard. Yeah. And that's not always been the case.
No, I think that's probably right. I mean, as our audience knows, I'm a very passionate Arsenal supporter. So it's been something that's been a good 20 years in the offing for us Arsenal fans to be able to crow at Chelsea fans, and so for us, long may it continue. Long may your footballing misery continue. But what I hope, my hope for you, Arjan, is the success of your football team and the success of your business are inversely proportional to one another.
Yeah. Well, I was there in 2012. I was there in 2021.
2021. Yes.
I don't know when you were there.
Well, so we may have been there in 2006, but for some unfortunate refereeing decisions. But there's not much you can do about that. But yes, it was. I quite enjoyed it. I quite enjoyed the Chelsea fans with their tinfoil European cups when they came to the Emirates a few months ago, and then we spanked Chelsea 5-0. So
I know.
It was long overdue. But unfortunately, probably doesn't replace the missing European Cups from the Arsenal trophy cabinet. Could be worse, though. We could be Spurs fans.
I don't think anyone disagrees with that.
There's the one thing we can agree on, football-wise. And apart from football and family time, any sport or any other lifestyle stuff that you do to sort of keep you regular?
I wish I could. I play tennis a lot. I love that. But it's unfortunately, getting older also means a lot of ailments, and I can't really be that active anymore. Unfortunately, arthritis in my hip. It's a very boring topic. Let's not go there. It just makes me a bit immobile, and it hurts. It's easy, just hip replacement at some point, then you move on. But it does affect my own sporting ability to. And people say you have to go to the gym, you have to go swim. If you've always done ball sports, going to the gym. It's just not in my psyche, right? So it's just walking to the pub, really. And, missing out a couple of tube stops. In the office, we walked for a while to the 10th floor and back as an office thing. That kept us fit. So we do play a bit of paddle once in a while. I don't know whether you know paddle, but I love playing that. It's really nice to do, and you don't have to walk as much.
No, and it's a smaller court, isn't it?
Smaller court. So the racket sports I try to still do and keep fit as much as I can.
The other good thing about paddle is that if the ball goes past you, it can come back to you as well.
Yeah.
Actually, it's funny because I'm very keen on my tennis. I've even got a match tonight, and so I think. If you want, we can compromise to have a bit of paddle next time, and I'll certainly take you to the pub. We'll have a beer. Couple of last questions. We were discussing it off air. With the election announced a week ago now, we're recording just at the end of May, so we've got about 6 weeks. I think the Parliament's dissolved today, actually. So this episode will be going out probably in a couple of weeks' time. Any predictions for the election? How do you see it going? And do you think there's anything? Do you think there's any shocks or surprises, or do you think it's going to be business as usual, whichever way it turns?
Yeah. First of all, I'm a Dutchman, so I'm not allowed to vote. I can just pay tax. Right? That's the way it is for me.
And we thank you for that.
We always have a coalition government, a very right one at the moment. I think the good thing about a coalition government is that it's more balanced and longer term. It's not like I can do this. A lot of English politics, more than others, is more about telling why the other party will fail instead of why you succeed and solve the problems. I think there's a mindset that should be just more collegial, collaborative, and move forward across party. I don't think that happens enough here. What will happen is we will see. I think that the problems that we have are so huge, it will need everybody to just get stuck in and work together to fix them. The polls, whether they're right or wrong, I don't know. What I do know is that what currently was being done is obviously hasn't had any effect for a while. I'm not a Brexit fan. I think that was a mistake, but that's my personal view. We need to get trade going. We can't be isolated. We're too small to be isolated because we have enormous number of geopolitical challenges. We need to work together with our neighbors much more than we currently do. So it's going to be interesting. I don't know who's going to win, but I doubt the polls can be that wrong. And change might be actually something that we need, not to use this. That's why I probably chose the slogan. But one of the things that we do need is to improve the situation. I don't think the politicians, because we're talking to a lot of them about long-dated fixed-rate mortgages, how we can help and what we can do. And you might have seen in the manifestos several focus points on that. But it's not the biggest barrier. The government is not the biggest barrier to do this. It's actually the Bank of England LTI cap. That's the biggest barrier to get the housing market moving. And that's, who can change them? Nothing. Nobody.
They are
independent.
They are supposed to be independent. Yeah. And, there's some discussion from the Conservatives about changing that, but I don't know. Personally, I think these things should be apolitical. But
and I totally agree with that. But on the other hand, there are also people, and in my view, they should just look back. What is the right thing to do to get the country back on and look forward? See, one of the things that I feel is that policies from everybody, the government, but also the Bank of England, rules and regulations, should drive the private sector in a certain direction and for where the country should be, instead of just, this is where it is and we regulate what's here now, right? And I think the Bank of England doesn't feel that as part of their mandate. That's for the government to do. And that's fine, as long as you don't have the power to block everything. Yeah. And unfortunately, that's where we are. So I think the government will see, I look forward to the manifestos and look for long-dated fixed-rate mortgages. That'd be great. And then we'll see what we're going to do once all the chips have landed.
Yeah, well, we'll see. We'll see. I actually had a lunch with someone who worked for a very senior Conservative politician. He was sort of a campaign manager, right-hand man for the best part of 15 years. And he's not actually campaigning this time around because this individual's standing down, like a lot of the Tory MPs. And he actually said something quite interesting to me, which is that when you actually look at to get that national uniform swing, some of the locations that need to go Labour, when you actually look at them in cold hard light of day, the probabilities of them going Labour are very, very low. And so as a consequence of that, in reality, he thinks that we're going to end up with a hung parliament. And then we're going to have to go back to the polls again in November to resolve things. So, which I thought was quite interesting because actually in this country, unlike in Europe, this country doesn't tend to do very well with minority governments or coalition governments. So we'll see. I sort of like to have a decisive outcome, but whether we see one or not, it will be fascinating to watch, but probably not for the best for the economy if we have that months of uncertainty that follow.
Probably not. But on the other hand, do we need decisions made to help the economy, or just having a period where no decisions are made is actually quite good?
I would actually favour no decisions. I mean, was it Belgium managed to exist
exactly.
for 5 years without a government?
And it worked perfectly well.
Yeah, I don't think there's many people who would argue that they wouldn't mind seeing the same here either. So.
It's a lot of people say leave us alone and just don't interfere, because a lot of people, the government policies and things are being there for political reasons instead of actually need in the market. Exactly right. So
it's like the VAT on school fees. It's a policy that's going to raise next to no money, but all it is it's a sort of rallying cry for to get the base going.
Yeah. And those things we should just do without, frankly. So that might be a good thing if we don't have that and get on with it. On the other hand, certain big decisions need to be made, and we have some barriers that need to be broken down. Yeah. Right, and that's important, and you can only do that with government.
Yeah, true. Final question: if you could give some self-talk to your younger self, so think back to a time when you were young and impressionable, knowing what you know now, what would you say to yourself then, and why?
I would have gotten into a real job earlier, as in, as an investment banker, you do this, you're on this treadmill doing the whole thing, and you actually forget that there is a bigger world out there. This is why the financial crisis happened, because you just go, right? And everybody does that. Yeah. Actually reflect and work with the real people, the real economy, instead of in the financial ivory tower. Really getting the job that gives you that as a background and as an experience is something that I now really, really value. And I wish I'd done that earlier.
So spend more time on, get onto Main Street much sooner and move away from Wall Street that bit earlier.
Yeah, that's probably a better way of putting it.
Oh, sorry. Well, I don't know. It just came into my head. But anyway, I think a lot of people are going to be really fascinated and possibly even inspired by some of this conversation that have been watching and listening. If someone wants to reach out to you, what's the best way to get hold of you? Is it LinkedIn? Is it through your company website? How should people try and reach out to you?
If they obviously are looking for a mortgage, etc., go to our website, Perenna, and support us. And LinkedIn definitely works for me. I'm always on LinkedIn, looking for information, challenging, and getting questions. People will see there's a flag in front of my name, and that's there for a very practical reason. All the bots say hi flag instead of just using my name. So those messages are being ignored.
That is a brilliant tip. Okay, so you have to put some sort of emoji in front of your name. Okay, you're right. We'll do that.
All the bots can be just, those messages.
I'm going to do that. I'm going to do that. Yeah, okay, because I get so much inbound.
Exactly.
Love it. Okay, brilliant. Okay, well, LinkedIn is the place to get hold of you. If you want to get hold of me, I am at property_funder across the various platforms, including LinkedIn, Twitter, not that I use it very much these days, and Instagram. Also at Property Funder Podcast as well on Instagram if you want to get hold of me. We even have a TikTok these days, so at Property_Funder on TikTok as well, where you can see some clips from our guests, and we'll probably have one with yourself as well. So it's been a pleasure, Arjan. Thank you very much for your time. I've really enjoyed it, and thanks to Eric Barnett, our mutual chairman, for making the introduction and setting us up. And we'll probably have to have you on in a year or two to catch up and find out how things are going.
Thank you so much.
Brilliant. Thank you.